So in this video, I want to discuss high yield investing. High yield investing, it's a very good strategy for maximum income. High yield investing is a strategy focused on investing in assets that offer above average income returns, typically through dividends or interest payments. These high yield assets can include, high yield bonds, often referred to as junk bonds, but they provide high yield. You have dividend paying stocks, real estate investment trusts, and other, income generating investments. The primary goal of high yield investing is to generate a steady, and a significant stream of income, but this this offer comes at a higher risk. It comes at a higher risk. You want to have regular income, high income, steady income. The risk is always there. Let's look at the key concepts of high yield investing. Number one here is high yield bonds. High yield bonds, also known as junk bonds. These are bonds issued by companies with lower credit ratings. They're not very reliable. Because of the high risk of default, these bonds offer higher interest rates or to compensate investors for the risk they are undertaking. So while they provide attractive yield, they also come with a higher risk of the issuer defaulting. The bond issuer may default. They may not pay. You may not get your coupon as at when due. Number two is dividend paying stocks. Dividend paying stocks. High yield investing often involve selecting stocks that pay above average dividends. These stocks are typically found in mature, stable industries like telecommunication, like consumer staples. Companies that pay high dividends are usually more established and generate considerable, amount of cash flow, but the stock prices, may be less volatile and have a slower growth. So these companies pay, an above average dividends. They pay a higher, amount as dividends, and they are found in utilities, in telecommunication, and in the consumer staples. Number two is a real estate investment trust. Real estate investment trusts are companies that own, operate, or finance income-producing real estates. They are required to distribute a significant portion of their earnings as dividends, making them a popular choice for high-yield investors. So real estate investment trusts can offer high yield, but may be sensitive actually to interest rate changes and economic conditions. They are very sensitive to change in interest rates. Whenever the country, alters interest rate, it will equally affect the returns from these real estate investment trust. Number four is master limited partnership. Master limited partnership. So these are often found in industries like energies and natural resources. They are similar to REITs in that they must distribute most of their earnings to investors in form of dividends. By so doing, they offer, high yield. This can be attractive for income-seeking investors, but come with specific tax consideration and industry-related risk. So you have to consider the amount you will pay as tax before you think of investing in these limited partnerships. Number 5 is risk and reward. High yield investing offers the potential for higher income but comes with increased risk. The assets involved may be vulnerable, to economic downturns, changes, in interest rates and company-specific issues. Investors need to consider or to carefully, assess whether the high income is worth the added risk they are bound to take. So we want to look at the approaches involved in this strategy. So what are the approaches you could adopt if you want to get involved in this strategy? Number one is diversification. To manage risk, high yield investors often diversify across different types of high yield assets, industries, and geographic regions. This helps mitigate the impact of any single investment underperforming or defaulting. Number two is credit analysis. For high yield bonds, investors must analyze the creditworthiness of the issuing company. This involves looking at the company's financial health, cash flow, and the likelihood of meeting their debt obligation. Can the company honor their promises concerning as it relates to what they're going to pay out to you as an investor? You consider all this. Number three is dividend sustainability. When investing in dividend-paying stocks, it's crucial to assess the sustainability of the dividends. This involves analyzing the company's payout ratio, that's the proportion of earnings paid out as dividends, cash flow, and overall financial stability. You have to take these factors into consideration to ensure whether the company can sustain its dividends, not only sustain the dividend, whether they can the payout ratio is growing year by year. Number four is interest rate sensitivity. They are sensitive to changes in interest rates. So high yield investments can be sensitive to changes in interest rates. For example, rising interest rates can make new bonds more attractive compared to existing high yield bonds, so leading to price decline. Investors need to monitor the rate trends and adjust their portfolio accordingly. You have to monitor, the change in interest rate as it's fixed by the government and see how you can, adjust our portfolio to take advantage of or to avoid the risk that comes with these changes in interest rate. I want to consider the advantages and disadvantages of high yield investing strategy. Number one under advantage is steady income. High yield investing can provide a regular income stream which can be especially valuable for retirees or income-focused investors. If you're income-focused, you are retired, you need regular income, then this is a very good strategy. Potentials for high returns. Number two, the higher yield can lead to greater overall returns, especially in a low interest rate environment. Number three is the diversification benefits. High yield assets can offer diversification benefits when combined with other types of investments, potentially improving the risk return profile of your portfolio. Then you come to the challenge, the disadvantages. Number one is higher risk. The higher yield come with increased risk, including the risk of defaulting for higher yield bonds or dividend cuts for stocks. A company may default, and some companies can even reduce, cut their dividend for one reason or the other. Number two is market sensitivity. High yield investments can be more sensitive to economic cycles, interest rate change, and market volatility. Number three is potentials for capital loss. If a company defaults or if an interest rate rise, the value of high yield investments can decrease, leading to potential capital losses. So, who is it for? High yield investing is suitable for income focused investors who are willing to take on higher risk in exchange for the higher potential return they expect from their investments. It's particularly attractive to those seeking to boost the income generation of their portfolios, such as retirees, but it requires careful risk management and due diligence. The higher returns are there, but the higher risks are also there. You need to balance the